172.36 USD. That is the price flashing on the screen at this very second. We are looking at a decline of $159.62, which translates to a staggering 48.08% drop in a single trading session. If you are watching the ticker for SMX, Security Matters PLC, you are witnessing one of the most violent corrections in the market right now. The volatility here is not just a statistic, it is a visceral experience for anyone holding a position. We are seeing a stock that has effectively been cut in half in a matter of hours, erasing gains that likely lured thousands of retail traders in just days ago. The volume is heavy, the selling pressure is relentless, and the bid-ask spread is widening as market makers struggle to find equilibrium. When you see a ticker like SMX, the expectation is often one of high-tech promise. You read the headlines about molecular marking, supply chain transparency, and digitizing physical assets, and the natural instinct is to think you have found a hidden gem that the broader market has overlooked. The narrative surrounding this company is incredibly seductive. It promises a world where every physical object, from gold bars to plastic bottles, has a unique chemical ID that can be tracked on a blockchain. It sounds like the future. It sounds like the kind of innovation that should be commanding a premium valuation. Investors expect a growth story, a clean trajectory upward as the world adopts these standards. But the reality, the brutal mathematical reality engaging us today is far more complex and far less forgiving. What we are seeing at 172.36 USD is not just a dip. It is the mechanical unraveling of a capital structure that has been engineered through massive dilution and reverse stock splits. The reality is that while the technology might be fascinating, the stock itself has become a trading vehicle for high-frequency algorithms and aggressive short sellers, rather than a long-term compounder. The drop of over 48% today forces us to look past the press releases and stare directly at the financial plumbing of the company. You are not just buying a tech company here. You are buying into a structure that has recently undergone a 10-for-1 reverse split in October 2025, followed quickly by an 8-for-1 reverse split in November 2025. That is the context you need to understand this price action. Let's strip away the hype and look at the market mechanics driving this massive red candle. When a stock drops 48% in a day after a period of intense volatility, it is rarely a coincidence. We know that SMX recently announced a massive $111.5 million equity purchase agreement with Target Capital. On the surface, receiving over $100 million sounds like a lifeline. It sounds like the resources needed to scale. However, the market is digesting the fine print of that deal today. Convertible notes and equity lines of credit often come with the caveat of future dilution. When a company can print stock to pay its bills, or a lender can convert debt into shares at a discount to sell into the market, the supply of shares creates a ceiling on the price. Investors who bought in during the hype cycle last week are now realizing that the float, the number of shares available to trade, might not be as tight as they thought. Consider how this plays out for the average investor using an individual brokerage account. You might be sitting at home, logging into your Fidelity mobile app or checking your Robinhood app, seeing SMX trending. You see it up 300% one week, and you feel the fear of missing out. You click buy. But what you are trading is not a stable asset like Apple stock or Tesla stock, where institutional support provides a floor. You are trading a micro-cap stock that moves on vacuum-like liquidity. When the sentiment turns, as it has today, there is no safety net. The drop from the 300s down to 172.36 USD happens in air pockets where there are simply no buyers. This is the difference between investing in a company with decades of earnings history and speculating on a company that is still in the prove-it phase of its existence. To understand why this is happening, we have to talk about the company's actual business because amidst this financial engineering, there is a real product. SMX specializes in digitizing physical objects. They use a marker system, chemical, molecular markers that can be embedded into raw materials. Imagine a gold bar that has a chemical signature inside it that proves it was ethically sourced, or a recycled plastic bottle that can prove how many times it has been reused. They call this the proof economy. The idea is to create a digital twin for physical assets, allowing for absolute transparency in supply chains. In a world increasingly obsessed with ESG, environmental, social, and governance mandates, this technology should theoretically be in high demand. They have pilot programs, they have announcements about tracking gold and textiles, and they have the buzz of blockchain integration. However, the disconnect between that technological promise and the share price performance is stark. While the company talks about the proof economy, the market is focused on the dilution economy. The recent reverse splits, consolidating shares to keep the price above NASDAQ's minimum listing requirement, are a massive red flag for institutional investors. When you see a stock undergo multiple reverse splits in the span of a few months, it signals that the company is fighting for its survival on the exchange. It resets the price higher, sure, but it doesn't change the underlying value of the business. If you had 80 shares worth $1 each, and they do an 8-for-1 split, you now have 10 shares worth $8 each. The value is the same, but if the price then drops from $8 back down to $4, you have lost 50% of your capital, and you have fewer shares to show for it. This is the math that is crushing retail portfolios today. This brings us to the broader landscape of online investing. Platforms like SoFi Invest or Schwab Intelligent Portfolios are designed to make investing accessible, but they also expose retail traders to these high-risk environments. When you use a Fidelity trading platform or an interactive broker's account, you have access to the same tools as the pros, but you often lack the speed. The algorithms driving SMX down 48% today are reacting to order flow and liquidity gaps faster than any human can hit the sell button on their phone. It is crucial to distinguish between investing, which is what you do when you buy an S&P 500 ETF or a steady dividend payer, and the high-octane speculation of a stock like SMX. The allure of turning a small amount of capital into a fortune is what drives volume into these names, but the exit door is always smaller than the entrance. Let's pause on the recent funding news because it's critical to the future outlook. The $111.5 million agreement is a double-edged sword. On one side, it gives SMX the runway to actually commercialize their tech. They have cash. They can hire, they can deploy their technology, they can sign deals. That's the bull case. The bear case, which is winning today, is that this cash comes at the expense of the shareholders. If the company has to issue millions of new shares to access that cash, every existing share becomes worth a little bit less. It's the classic struggle of a pre-revenue or early-stage growth company. They need cash to grow, but getting cash hurts the stock price. The market is currently voting that the cost of this capital is too high, hence the $159 drop. This massive volatility also brings up the role of short sellers. In a stock like SMX, which has surged hundreds of percent in days prior to this crash, short interest is likely high. Traders bet against the stock, expecting it to revert to the mean. When the stock was flying high in the 300s and 400s last week, short sellers were getting squeezed. They were forced to cover at losses, driving the price even higher. But now, the momentum has broken. The shorts are back in control, pressing their bets, and the long positions are liquidating. This creates a cascade effect. Stop-loss orders, automated instructions to sell if the price hits a certain level, are being triggered one after another, creating a domino effect that accelerates the decline. It's interesting to contrast this with how you might manage a portfolio on a platform like Fidelity Wealth Management, or even using a robo-advisor like SoFi's robo-advisor. Those services typically steer you away from single stock volatility of this magnitude. They build diversified baskets. But for the self-directed investor, the one using Robinhood cash management to fund their trades instantly, the temptation to catch a falling knife like SMX is real. You look at the price of 172.36 USD, and you might think, it was 330 yesterday, surely it will bounce. This is the anchor bias, anchoring your value perception to a previous high price. But the market has no memory. The stock doesn't know it was at 330. It only knows the liquidity available right now. I want you to take a second and think about your own exposure to these types of plays. Comment below how many shares of SMX or similar high volatility stocks you currently hold, or tell me if you stayed on the sidelines for this one. It's always fascinating to